Just a quick video, just a couple things that I'm a little bit concerned about. I don't think it's anything to be overly concerned about because I don't think it sort of points to any kind of trigger that might start something. But if something does get us to certain levels, it could be sort of an accelerant effect that we see in here. So let's take a look at, we've got this silo that I've been talking about, this kind of upper end of 6,100. This is no secret. A lot of people are talking about this. Below 6,000, we get into a little bit of a problem, especially below 5,900, 5,950, we get a little bit of accelerant. So what that means is there's negative gamma down there, which means dealers are predominantly going to be short options there. So positive gamma is supportive of markets, can support markets on the way down. It can provide selling pressure on the way up. Within a reasonable measured way. These red areas are where we can potentially get movement that kind of spirals into more movement. So volatility begets volatility, right? You get a little bit of movement down, and then a lot of factors that I'm going to talk about in a moment start to kind of pile on top of that. So it's not a supportive environment. It's an environment where things can actually get going in one direction and kind of keep going, right? So that's the important point. We've had this very, very high vol environment pre-election, a little bit post-election into NVIDIA, and then we've really kind of collapsed. So we've seen realized volatility extremely cheap. S&P puts in the near term, 30-day out, sort of at the monies, are about as cheap as they've been only a couple of other times in the last 25 years. So there's no question, low movement is being paired up with very low option pricing. Could actually be lower, right? Option pricing, as low as it is actually probably a little bit high given the movement we're seeing in markets, right? So that's kind of that weird effect where low option pricing can actually be expensive, is the same way that high option pricing can actually be cheap when the market is really struggling and having trouble. There's a lot of volatility. A VIX 22 could be very, very inexpensive. So you have to always think of volatility in the sense of that's a relative product. It's relative to what the underlying risk is. And so that can that's an important thing to keep in mind when you're trading options, when you're trading volatility, when you're looking at sentiment indicators, risk gauges. You have to understand that this is a relative value game that we keep in mind. And that's why we always like to compare movement to option pricing to kind of get an idea of where we are within that spectrum of, are we cheap, are we expensive? So if we look at this here, we can see that there's some concerning things. You know what, I'm going to show you this first. So this is the VIX upside curve on November 29th, the sort of faint yellow line here. Quite normal to see upside call skew, just sort of steer upwards because people are buying upside calls for protection in the VIX. What we've seen is that we've seen a very steep steepening of this particular skew, right? This sort of volatility structure in that space. That's a sign that people are sort of not really wanting to sell very much upside VIX, right? They don't really want to sell these calls and they're backing away. They're either selling enough, backing away, or they're just saying, look, I don't have the budget for something like this. I don't want to get into trouble. We'll kind of draw some conclusions in a moment, but basically people are sort of stepping back. Market makers are saying, I'm not really a big fan of selling this. And we're seeing this supported in some other areas. So if you look at something like this, let me see if I can expand this a little bit. No, I can't. Okay, so you're looking at, let's talk about real VIX, and then we'll talk about synthetic in a moment, synthetic gamma. So VIX calls dealer positioning. So try to stay with me here. This is where, are dealers very, very short calls? Are they neutral? Are they long calls? Well, they're probably rarely long calls, but in this case, we can see that over the years, they're shorter and shorter calls. Right here, we're kind of getting back down to sort of these mid to late 2003 levels in terms of dealer short call positioning. So this is maybe giving us some indication of where this is coming from, right? And those little charts are probably a little bit older, a few days old. So this may be happening in real time over the last few days this week, where this is starting to get a little bit steeper, meaning this particular effect is maybe they're getting shorter those upside calls. So they're a little bit nervous. right? And so we can look at this in terms of dealer gamma imbalance. So the gamma imbalance, if you look over here, dealers are predominantly short upside calls in the VIX. And so remember, we talked about green being supportive and red being an accelerant area. So above 20, we see that dealers are either sort of neither here nor there, or they're short a little bit of gamma, which means if you can get, in theory, what this means is if you can get the VIX moving, there is less in the way to keep it from continuing up, right? So there's sort of this potential snowball effect in that space. And when did we see this? Well, we saw it in the summer, right? People threw out protection the first half of 2024, and we got to that sort of this area where McGillicuddy calls it sort of this buildup of energy, this buildup of sort of complacency that eventually led to a trigger, right? It doesn't do anything on its own. You need something to get the market down, to get that ball rolling down the hill. And then that's when some of these things can get triggered. So the Japanese yen carry trade was one of those things. We saw a weakening in some big cap and some AI plays as well. And there was a kind of confluence of factors that started to sort of add to that snowball running down the hill and getting bigger and bigger, right? You know, the snowball just gets bigger and bigger and bigger in the cartoon, and then somebody gets smacked at the bottom of the hill. Well, who got smacked? The market got smacked really hard. So in early August, all of this kind of came to a head, and there was this buildup of energy. There was this disregard for protecting portfolios, and it came back to haunt a lot of people. And so we had this kind of mini Volmageddon event. And so we're seeing, I think you can make the argument that we're starting to see a little bit of this energy again, kind of building. And so again, I mentioned you need that trigger. What's the trigger going to be? I don't know. But what we have to acknowledge is that we are seeing a little bit of, let me grab a little chart for you guys. We're seeing a little bit of weakness below the surface in this market. So here's the S&P equal weight. So if you want to look at the S&P 500, which is a market cap weight index, it gets skewed by so many names that have a very heavy weighting in the index, right? So we know those big names, those big Mag 7 names, these large companies have a very big influence on that particular index. Now, if you make everybody the same weight, the small company is worth the same as Amazon or Google or Microsoft, then everyone's equal weight. And you can see that the equal weight has been weak. And what does that mean? Well, it means if you sort of strip out the factor that is heavy weighting in the index, the overall market isn't really doing that well. So beneath the hood, beneath that veneer of a heavily concentrated rally that we've been seeing lately, we've had some broadening out second half of the year. But lately, look at this. I mean, December, we barely had an uptick in the equal weight index. That is unbelievable. We're seeing Tesla new highs, Microsoft new highs, Amazon new highs, Google's smashing back up towards all-time highs. I think it made all-time highs as well. Apple all-time highs. Everything looks fantastic in Mag World, doesn't it? Look below the surface here. Something is going on. There is a weakness below the surface, and this is something to take note of, because a heavily concentrated rally is one that isn't as healthy from the sort of broader perspective. So maybe that's all this is. There's some nervousness about this being sort of a handful of names that have been doing well below the surface. We're having a little bit of trouble, but the hope as a bull would be that we're here at the bottom of this trend, this channel, and we usually bounce from there, right? We usually bounce, and then the broader market makes a comeback. And this hasn't been unusual lately. We've seen this game of hopscotch, right? Where it's Mag goes for a little run, and then the rest of the market goes for a little run. It's kind of part of my roaring 20s sort of narrative that I've been talking about since the summer. So this kind of like, it's not that one has to do well and one doesn't have to do well. They can kind of take turns sort of doing their thing. Now, we do have some new questions surrounding where are rates going to go. We're starting to see some inflationary pressures again, which is exactly what I talked about in the summer. I said, what is Powell doing dropping interest rates. Regardless of what you think of that, this is something that the higher for longer might be here. And we're seeing some weakness in IWM, which is the small cap 2000, the Russell 2000 small cap stocks, which is taking the wind out of some of these sectors and areas that really need lower rates to do well. Lower rates are great for a lot of companies that have a lot of floating debt, that have employees that need to get paid. A giant part of the population, of the working population, works outside of the Mag 7, right? We need, employment-wise, we need rates to come down. Can they come down if we're starting to look at inflation again, starting to rear its ugly head? That is what we're worried about. Is it going to be a 70s, 80s redux of, those Volcker years where we just kind of controlled inflation and then it came raging back? I'm not so sure that happens, but without question, there is some firmness out there on the inflation side. And I think the Fed can handle some of that, and even the market can handle a good amount of that as well, as long as we get good growth, as long as employment is good, and inflation doesn't get a little bit too uncomfortable. So we're seeing a little bit of a curve reevaluation on the bond side. We're seeing some sort of firmness lately in the short end, and we're seeing some rates firming, and we're seeing TLT come down, and we're seeing the short-term rates kind of stabilize a little bit. So long-term, we're seeing maybe bonds are a little bit nervous about inflation. So we do have some cross currents, and I think that is starting to work its way into things. Now, we see the VIX down around 14. That's okay. It could be a little bit lower given the seasonal period that we're going into, but we're also seeing the VVIX a little bit high. It's sort of pushing 100 again, which is not a place of comfort. It has gotten, of course, to 120, 130, 140, but it's still kind of in that uncomfortable place. I'd like to see it down in the 80s again to feel a little bit better about risk gauges being low. So this is very interesting. I mean, the equal weight is definitely showing some concern. And look at the SPY market weight. I mean, it's just unbelievable. We're near all-time highs, like nothing is going on. We've got this massive amount of gamma that I've been talking about that's really, putting the clamp. It's like the market's playing ping pong over this net. The net is the 60-55 collar level on that JPM collar, and we're kind of smacking the ball back and forth over that net. We're going to have to see how long that lasts. I know there were some big gamma supportive positions around the 60-35 level a few days ago. I'm not sure if some of that's been rolled, but next week is expiry. It is the biggest expiry of all time. So the concern that I'm talking about, let's wait and see if that develops a little further. Do we continue to see these levels of under the hood worry continue? These are small things, right? The typical thing you look at is the VIX, you look at the move, you look at a few of those sort of top line risk indicators, but there's some stuff under the surface that could lead me to believe that there is more nervousness than we think. And so next week, given all those massive gamma positions, we may see a continuation of a low volatility. What worries me is that we get past expiry and we get into a free to roam about the cabin, as I like to call it, kind of scenario where the market can then, in the absence of all this sort of supportive gamma, it can start to do its own thing again. So we're going to have to wait and see how that turns out. So don't be surprised if next week looks a little different from the following week, which is going to be holidays, eggnog, and people taking time off, and low liquidity, which is going to coincide with, except for that JPM collar that runs into December 31st, we're going to be losing a lot of potential gamma and support to this market that is putting a clamp on the market. Now, in theory, that could mean that we run up over 6,100. But given the nervousness I'm seeing out there, I'm a little bit worried that we start to move towards below 6,000, and then that could turn into something a little bit more concerning. So I'm going to be acting appropriately next week in terms of closing some risk positions, adding some hedges. We're going to be doing that in the community. The community is something you can get involved in. We've been doing some amazing things. We do cash secured puts, we do cover calls, and we do all kinds of other cool stuff. VIX, hedges, all sorts of fun, risk reversals, butterflies, you name it, we're on board with anything that makes sense and is giving us edge, right? It's all about looking at things from an edge perspective. Your edge can come from the chart. Your edge can come from the fact that you think the lineups are long at the Apple store. It can come from all kinds of places. For us, it often comes from what are we seeing in the volatility space and where are the warnings, right? There's definitely this idea in my mind that success comes as much from avoiding stepping in these massive potholes as much as it does from getting those good trades set up and having those good trades work out for you. So it's always having this kind of holistic view of things and being aware of where the risk is to the extent that you can, right? We can't get things perfectly. So if you're interested, look below, check out all the cool things that we have, and we'll see you guys in the next video. Next week could be interesting, I gotta say. And you can bet that I'll be making some new videos and I'll be keeping you guys updated. Okay, have a great weekend, and we'll see you then. Bye bye.